Hey everyone, glad you're here. The Federal Reserve just lowered interest rates for the first time in 9 months, bringing them down to roughly 4 to 4.25%. On paper, that might seem like a small technical tweak, but moves like this can ripple through your wallet in ways you don't always see right away. They affect everything from mortgages and car loans to savings accounts and even the prices of things you buy every day. There's also a political backdrop that's making this moment especially interesting. So stay with me. Understanding what's happening can help you make smarter choices with your money. Before we dive in, I'd love to know, do you feel these rate changes in your day-to-day life, or do they feel far away? Drop a comment and let me know. And while you're at it, hit subscribe if you haven't yet. It really helps us keep building this community. So what does this cut actually mean? The big picture is that lower rates are meant to make borrowing cheaper. Mortgages, car loans, personal loans, in theory they should all come down. But today's economy doesn't always work in straight lines. Take home loans. Even with the Fed's decision, the average 30-year mortgage is still over 6%, way higher than the 3% people were able to lock in just a few years ago. Most of the market had already expected this cut, so banks and lenders had priced it in long before the announcement. That means you're not likely to see a dramatic drop in mortgage quotes just because of today's news. For homeowners thinking about refinancing, it only makes sense if you can save at least half a percentage point or more. If you bought your house during the pandemic lows, holding on to that old rate is probably still your best bet. Credit cards are another area where people hope for relief, but the reality isn't as friendly. The average APR is around 20%, and even after a cut from the Fed, the drop on your bill is going to be tiny. Credit card interest is sticky. Banks don't rush to lower it. So if you're carrying a balance, don't expect your payment to magically shrink. The smartest play is still paying off high-interest debt as fast as you can, because no rate tweak is going to make those charges cheap. Savers, on the other hand, might feel this shift more clearly. Over the past year, online savings accounts were paying over 5%, which felt like a treat after years of earning almost nothing. But now those rates are slipping toward the mid-4% range, and if cuts keep coming, they'll slide further. That doesn't mean you should panic, but it does mean the easy ride of earning solid returns on cash might not last. If you've been enjoying high-yield savings or CDs, this is a good time to think about locking in while you can. Some banks are still offering short-term CDs around 4% with no penalties, which give you both yield and flexibility. Beyond that, people looking to keep their money working without big risk could consider short-term bonds or high-quality corporate debt. They're not for everyone, but they can offer a bit more income without tying up your cash for years. Whatever you choose, be intentional. Don't assume your bank will keep paying you the same just because it did last month. And remember, even if savings rates drop, keeping a solid emergency fund is still crucial. Experts often recommend 3 to 6 months of expenses in a liquid account, even if the return isn't great. Emergencies, car repairs, medical bills, sudden home fixes are one of the main reasons people end up relying on high-interest credit cards. No Fed move can protect you from that if you don't have a cushion. There's also a political angle to this moment. The Fed is supposed to operate independently, but lately there's been pressure from Washington to cut rates faster. Some leaders argue that high borrowing costs are weighing on housing and on government debt. There's been public debate inside the Fed too, with some officials wanting bigger cuts and others preferring to move slowly. That tension can make markets jittery and adds uncertainty for all of us. The Fed's credibility comes from being seen as above politics, so when its decisions get tangled in public fights, it can shake confidence. For regular people, that means policy could shift faster, or in more surprising ways than usual. Investing is another piece of the puzzle. When rates come down, savings accounts and CDs lose some of their shine, and that often nudges money into stocks, especially companies that pay steady dividends. Banks and other financial firms sometimes benefit because they can borrow more cheaply. But it's not all upside. If inflation doesn't cool, your real returns can shrink. And if the economy slows too much, stocks can still slide no matter what the Fed does. That's why balance matters. Keep your portfolio diversified and don't chase a single trend just because rates moved. Rate cuts are really more of a signal than an instant solution. They tell us the Fed is paying attention to growth, jobs, and inflation, but they don't erase your credit card balance or knock a full point off your mortgage overnight. What they do is create an environment where being strategic pays off. That means tackling expensive debt, shopping around for the best savings deals while they last, and remembering that policy can't fix everything for you. Perspective is key too. The era of zero rates isn't the normal state of the world. We're in a middle zone now, where borrowing isn't free but it isn't punishing either. Adapting to that reality is part of staying financially healthy, so I'd love to hear your take. Do you think this rate cut will make a difference in your finances, or is it more background noise for you? Let me know in the comments. Your experiences help others see how these changes play out in real life. If you found this video useful, give it a like, subscribe, and share it with someone who might benefit. Thanks for spending this time with me, and I'll see you in the next one.